Hello, welcome back. So in today's video, I'll be talking about why paying up for quality shouldn't matter so much. So in today's video, I'll be covering a few things. We'll be covering why paying up for quality is fine, when I'm adding to the compounding machines, as well as some questions that you guys have left me in the comment section below. So let's talk about the first portion, which is why paying up a little is fine. So when it comes to your compounding machines, they have high ROIC, and when you have a mixture of both high ROIC as well as high reinvestment rate, it leads to more growth. Because your growth of your business, your expected growth, is your ROIC times your reinvestment rate. The higher the ROIC, the higher the expected growth will be. The other benefit of a high ROIC is when you have a high ROIC and high cash retention, it leads to the company being able to redistribute the cash to its shareholders through buybacks as well as dividends. And the other qualitative factor that your high quality business have is durable moat. So high quality business, they have durable moats that can fend off competitors, allowing it to maintain its market share and grow above the rate of the industry. So Microsoft had Microsoft Teams, Zoom had their Zoom platform, but people had to switch over to Microsoft Teams because they had to use the other products in the Microsoft package as well. So Microsoft 365 or Microsoft Office and so on. And so although Microsoft doesn't have the best product, people still were forced to use the Microsoft Teams. So that is an example of a durable moat, a company that is able to fend off competition, like Microsoft being able to fend off Zoom. Next thing, your quality businesses, they can survive any sort of environment. So quality companies have the balance sheet and durability, as well as their competitive advantage to survive any sort of economic environment. So for example, if inflation comes, all these companies, they have pricing power. They'll be able to raise prices at levels above the rate of inflation. And they can also survive any sort of credit event as well with their strong balance sheet. So if you're to look at all your different high quality companies, I'm sure their balance sheet will be very, very healthy. Next thing, quality companies also have a massive runway for growth. So quality companies will be able to grow predictably over the next 10 years, and that will increase your terminal growth rate when you're doing your DCF calculation. So this is my DCF for Visa. So assuming an 11% free cash flow growth rate from year 0 all the way to year 10, and assuming a 3% terminal growth rate, the company's fair value is at around $270 a share. But Visa, being a high quality company that it is, will likely be able to still grow at upwards of 5% after year 10 or so. And so if you increase that terminal growth rate to around 5%, then it makes Visa a lot more reasonably priced today. So the fair value for Visa with a 5% growth rate is at around $343. So for your high quality companies, if they're able to grow predictably after 10 years and still continue growing, and that will increase the fair value for all these businesses. So for example, Chris Hone in his interview, he highlighted a company which is Moody's. Moody's over the past 50 years has grown at a 10% revenue growth rate. So if a company is able to sustain such high revenue growth rate over a sustained period of time, then likely the intrinsic value of the business will be a lot higher than what the PE suggests. So another thing to take note of is that time will allow compounding to take into effect. So if you buy a quality business at 40 times earnings, for example, if they grow EPS at 20% predictably and hold the stock price stable, then that will be a 16 times earnings in about 5 years' time. So a lot of your predictable stocks, they will be able to grow into their valuation itself. And that's why paying a little bit more currently shouldn't be a problem when it comes to buying your high quality compounding machines. So buying high quality compounding machines and holding them long term also reduces your mistakes. So if you are constantly searching for deep value stocks, it leads to mistakes as well. Whereas buying high quality companies and holding them long term is a much more predictable way for you to get return, although the upside is a lot lesser as compared to your net, but at the same time, you're reducing your risk as well. So this is what Monish Prabhai has said about buying compounders over undervalued stocks.
You talked about the value investing tent. And you also talked about 20 punches. And if my understanding is correct, then the 20 punches naturally causes Warren Buffett style of investing to go look for compounding machines, because you have limited time in your lifetime when you're going to identify compounding machines, and in those times he has been willing to pay what traditionally may not sound like value. For example, he paid like 28 times earnings on Moody's, and he paid 25 times on Coke. And there's obviously the other extreme of like Ben Graham. Where exactly do you fall in, and have you felt the urge or the need to say over your past career that I need to change my tent and move slightly here, slightly there? What has been some of the thoughts?
Right. Yeah, that's a great question. The best possible business you could invest in is a great business that's growing at a nice clip, and that has high returns on capital, and one that can absorb the capital it produces. That would be the kind of the gold standard. Probably Google gets the closest to that. I would say even a business like Coke or Amex, the problem is they're very good businesses. Yeah, they're not able to consume the cash they put forth. So those types of businesses, which are compounding machines, which are able to absorb capital, tend to be few and far between, and tend to be ridiculously overpriced typically, or at least on perception basis they're overpriced. So if you can't find that, then you go to plan B. And Buffett has done, even now he continues to do plenty of plan B type investing. So for example, he bought the debt of a specialty finance company called Finova, which was basically just mispriced, and they were just looking for that whole thing to be in runoff, and they would make a return on it. But it's nothing like Coke or Amex. And so I would say first plan, compounding machines. You can't get that, then you go to plan B, which is undervalued assets and so on. I have learned, probably the hard way, that it's better to put as much as you can on the great businesses with great managers, even if you pay up a little bit. But old habits die hard. We still like to have that hunt for the extremely cheap business as well. And so it's a mix. I would say that it's a mix, and it just depends on. I'm flexible. I think it's very important in investing to be a learning machine, and to have flexibility, and to be willing to look at the opportunity set and decide whether you need to do anything at all, or what is the best thing you can do based on the available opportunities, and then take it from there. So sometimes it can just be one of these mispriced bets that plays out in 2 or 3 years, and maybe that can go into a compounding machine and so on. So flexibility is a good trait, but it's always good to get into those compounding machines. I think those are the holy grail.
So what Monish Prabhat has said is that the best way of approaching investing is to buy your high quality businesses instead of prioritizing those that are undervalued, because your high quality businesses, they'll be able to compound their intrinsic value over time. And although they'll look overvalued currently, in 5 years time, in 10 years time, they'll look a lot more reasonably priced as compared to today. So next portion, I'll be talking about this comment over here. This comment was from someone that said that overpaying matters. So he said, I disagree. Overpaying does matter. If you overpaid buying Microsoft stock, P was around 50 back then in March 2000, you did not break even until February 2016. 16 years later, not everyone is like Warren Buffett and willing to wait decades for the stocks to generate huge returns. Same thing with Amazon. If you overpaid for Amazon in 1998, you did not break even until 2017. That's 19 years later. We do not have a recession since 2008, so younger retail investors think that stocks will only go up every single year. They do not know that we do have a rare situation where stocks can go nowhere for years, and during recessions or after bubble burst. So I agree with him. This is what he's saying. He's saying that Microsoft basically produced no returns for almost 16 years if you bought it at the peak of the dot-com bubble at 50 times earnings. But it's all perspective and time frame. So if you're to buy Microsoft stock at the peak in 2015 and ride it all the way till now, that is around a 5x in terms of the stock price itself. So buying Microsoft stock at around a 40 times earnings in 2015 will have given you a 5x. In fact, it's a 8x over here. So it's all perspective and time frame. So I'll leave it to you to decide which approach is better for you. So in summary, overpaying a little is fine. Make sure the degree of overpaying is as little as possible. Time and compounding will give compounders alpha above the market, but of course, don't buy in bubbles when the market PE is at around 45 times earnings. So in 2000, the P ratio for the S&P 500 was at around 45 times earnings. If you think the markets are overvalued now, the markets were even more overvalued in that bubble. So obviously, don't buy in all those bubbles, but inevitably, when those bubbles come, people will start piling in, and that is when you should be selling all these stocks. So in summary, overpaying for your companies in normal market conditions is fine as long as the company is high quality. Next portion, I'll be talking about when I'll be adding to the high quality stocks. So there are 3 businesses that I think that are extremely high quality that I would like to add in the future. The first one is Microsoft. Microsoft's fair value is at around $400 a share. Currently, it's trading at around $470 a share. So my next add for Microsoft will be at around $380 a share. Hopefully it gets there soon. I think the stock right now is slightly overvalued, so let's see where this one goes. Next stock is S&P Global. So S&P Global, my fair value is at around $500 a share. Currently now it's trading at $519 a share. So my next ad for S&P Global will be at around $440. I had a lot of my ads between $460 and $490. So I would like for my next ad to be at around $440. Next one is Visa. Visa is a company that has outperformed the S&P 500 by quite a large margin this year, currently up 17%. And for Visa, it is quite overvalued as compared to its fair value. So my fair value for Visa is at around $300 a share. I do believe that this company is extremely high quality and I don't mind paying fair value for this company. So my next ad will be at around $300 a share. Hopefully you get a DOJ lawsuit soon or some form of regulatory risk that will push down the stock price. But for now, I'm just holding. I'm not planning to sell my Visa. I'm staying out from buying this company for now. Last portion, I'll be talking about some questions that you guys have left me in the comment section. So the first one over here, it says, thanks for the video as always. Thank you so much. Any thoughts on Uber? Overvalued right now and Google's Waymo could take away market share, but business looks solid. So for Uber, the current stock price is at $85 a share. It is up around 35% year to date. It is one of the highest performing S&P 500 stocks. So the P ratio right now is slightly deceiving. It's at around a 15 times earnings. But if you're to look at their earnings itself, a lot of their earnings actually came from a tax expense. So they had this portion over here, which is your benefit from income taxes, which was around $402 million. And for Uber, they have this segment as well, which is under your other income. So they include a lot of their other income sources from their realized gains in investments into their income statement. And that is bumping up their earnings. So if you're to just adjust their earnings itself, Uber is currently trading at a 40 times earnings. So for Uber, this is the bear thesis, which is your robo-taxis. So your robo-taxi, they will eventually come, be it 5 years or 10 years. Waymo is already doing it at a very small scale. So robo-taxis will drive down costs, which leads to lower dollar profit for Uber because they take a percentage of the dollar amount that the ride share generates. And although you'll be able to get more car rides with lower prices, there will be a certain limit to the number of car rides that your dense cities can have. So for Uber, I think robo-taxis are generally bearish for this stock. I mean, if Google's Waymo is able to scale it up and make it wide scale, then they will likely be able to evade Uber's service and just create their own platform itself. Same thing for Tesla. So over the long term, I don't see the predictability of Uber, and that's why I'm staying out of this stock. Next comment is, what's your fair value for Nvidia stock? Have you thought about buying it? So for Nvidia, it's currently up 2% year to date, currently trading at a 45 times earnings. And for Nvidia, this is their Q1 earnings. Their Q1 earnings were slightly lower than expected because of the China export restrictions. And the main thing to look out for Nvidia is their gross margins. So over the past few quarters, their gross margins have been decreasing over time, and that is signaling a weakening of the moat of the business. So Andy Jassy, as well as all the other CEOs like Mark Benioff as well as a super investor in Dev Kantesaria, they have said that AI will likely become a lot cheaper in the future. They will become commoditized. And when your AI offerings become commoditized, that is when you see Nvidia's margins being hurt over time. So if Nvidia is unable to sustain its margins, its earnings will likely be hit as well, and then you will see the growth slowing, which will be detrimental for the stock price. So that is one of the bear cases for Nvidia. Besides that, you also have your TPUs from your hyperscalers as well. So for Nvidia, this is my problem with the stock. The stock is so reliant on just one revenue stream, which is their data center stream. The data center revenue alone is about 10x of all the other portions combined. So when you see such explosive growth in the business itself, in one singular segment, this is risky. So for me, I'm staying out of this one. I think Nvidia will benefit in the next 2 to 3 years. But in the next 5, 10 years, I don't see the predictability of this business. I don't think it'll be able to sustainably grow for the next 5 to 10 years at this growth rate. I hope you guys have found this one useful and invest safe.